Yo, what's going on, everyone? Welcome back to another YouTube video. I hope you guys are all having an amazing day, week, morning, night, wherever you may be. I know I definitely am, alhamdulillah. And I just came up with this new video idea to go over a very important concept that's not generally talked about. And this concept that I refer to is called the cycle. Now, of course, there's multiple cycles in Forex. Everything has a cycle. There's the cycle of human food chain, or not human food chain, sorry. There's the cycle of food, the animal food chain. There's a cycle of human psychology. There's a cycle of genetics. There's literally a cycle to everything in life. And there's also a cycle to Forex. Now, I can't go over all these different cycles in Forex, but I want to talk about one in particular which stands out. And in the more recent market structure environments, it definitely stands out. We see this all the times, we see this all the time. And I thought, why should I talk about something which is not seen, maybe seen once in a year, once in a month, over something that's seen, something that we could actually talk about that's happening today. That way, when you go to the charts the next time, you can think, oh yeah, TraqFX talked about this, or someone else talked about this. I know what to do. So, without further ado, let's get straight into this video. This one is called cycle number 1. There's not a specific name for it, but it's more specifically a pattern that's being followed, right? What this pattern is the hypothetical. It looks like this. Essentially, it's a move down, right, and then a move up, and then it's followed up with an impulsive move down that takes out the next low right over here, right? The key is that we're taking out the last low. And then from there, the market is retracing into the area of supply, which was initially created. And then from there, the market is moving down. Now, mind you, this cycle will not be found on all time frames. It's more specifically found on the higher time frames, or it's easily more visually seen on the higher time frames. Meaning you could possibly maybe find this on the 1 minute or the 2 minute or even the 1 hour. But because of the manipulation and the excessivity, I'm not even going to try to say that word. Because of the excess amount of candles, it can get confusing and your chart tends to get cluttered up. And you might, what could happen is you feel like you see it, and it's forming, but the last second the market reverses and then you figure out that wasn't actually the cycle, it was just a manipulation. So this is the full cycle right over here, and it's generally seen on the higher time frames, starting from the weekly, daily, and 4 hour. Mainly the weekly, daily, and 4 hour. On the monthly, sure, the monthly won't provide you with enough information to construct a end decision on what you want to do or what's happening, right? So yeah, just to sum it up, the monthly won't give you enough information. So what this cycle is like I said, the market creates an area of supply. Now, for the sake of the example, let's pretend that this cycle is the daily time frame. We found this on the daily time frame. So what happens is the market retraces back into the daily area of supply. Now, the first daily area of supply, this is going to be the supply zone, which starts a huge move. A huge move. Repeat after me, a huge move. What I mean by a huge move is basically, of course, there has to be a starting point to everything. The market isn't just randomly going to sell off. What the market does is it creates demand and supply levels, or also known as order blocks, and then price action is forced to retrace back into certain order blocks, and then the market falls. As in, if there was no use to these order blocks, the markets would never actually mitigate them. So we know that there's some type of cause, there's some type of importance or significance to these zones. So now we know that there has to be an origin, right? There has to be the market must create the zone at one point, or not the zone but the level. And once price action starts to retrace back into that level and we start to see weakness, that's the first sign that this is your zone. This is the supply zone or demand zone that's going to cause a huge downfall. In this case, we're using a bearish example. So we can see that price action reaches the zone, and then for the next few weeks or possibly even months, the market just continues to fall. Now, this is a very vague and broad way. Sorry, not broad. I'd say this is a very vague explanation of it. So I'm gonna have to go more in depth to give you a better example. More specifically, we're gonna go in depth. Not in depth. Sorry, we're gonna break down what's happening in this highlighted, matter of fact, I'll just use zone, but what's happening in this highlighted area right over here. What's happening here, because this is where the juicy stuff is. This is where you're gonna find the entry and the profit possibly. So deeper look at cycle number 1. What's actually happening is after the market reaches the weekly level of supply, all the orders which the market needs, right? All the orders which the market needs in order to fall, in order to sell off and fall for the next few weeks and months are being provided. And the analogy I like to use is, imagine you're going on a road trip in a car and you go to the gas, and before you start your road trip, you plan on hitting up the gas station to fill your car with the sufficient amount of fuel to successfully finish the trip, right? And you're not going to go with a half tank, you're not going to go with less than a half tank, you're going to go with the full tank. And that's essentially what happens. The market is actually retracing back into the supply zone to recharge, pick up all the orders that the market needs, and after those orders are transferred via the order block or the supply zone, the market has enough orders to go down. Okay, that might be a little bit confusing. Cool. Let's break this down even more simpler. Let's say I'm a market maker and my boss says, hypothetically, my boss says you need 2 million orders, forgive my handwriting, but you need 2 million orders to fall down to level 0, or not level 0, level 10. Let's say the goal is level 10, all right? I have to get to here. This is the goal. I have to get to here. But in order to get there, I need to have 2 million orders. Now, let's assume I can go to door number 1 and I open it, but there's only 100,000 orders. So of course that's not going to be sufficient. I go to door number 2, 300,000, better, but not enough. And then I go to door number 4, or 3, sorry, 500, not enough. But then I go to door number 4, and then they have about 2 million to 3 million orders. Let's just go for 2 million. The exact amount of orders I need is behind door number 4. Now, delete the word door and replace it with order blocks. We have 4 order blocks. So now this is going to start making sense. 1, 2, 3, 4. These order blocks have a specific amount of orders that they can produce. It's like a sponge. Every sponge has some water. A sponge that's been soaking in the sink for a couple of months is going to be way more wet than a sponge that's just been dabbled in a couple drops of water. Similarly to an order block, some order blocks are stronger than other order blocks. Very, very simple. And order blocks carry orders. Now, behind order block number 4, there's 2 million orders, which is the sufficient amount of orders the market needs to fall. So that means that if the market is at, for example, door number 3 or order block number 3, which is this, focus on this right now, this red zone. Let's assume, or let's turn it to purple, and let's assume that there's a order block there. Now, notice how the market reaches it, and then it reacts off of it for a short period of time, but then it reverses. What was that? That was an insufficient amount of orders being produced into the market, and yes, it had an effect, but it did not have the effect which you were expecting, which was a huge crash. And that's simply because of the lack of orders. Really, really simple. Now we head to order block number 4, where the market reaches the important higher time frame key point of interest, and then from there all the orders are produced, they're transferred, and then they're reproduced, and then the market executes them. And then that causes a full week's worth of downtrend movement, right? And now more specifically, if we take a deeper look at cycle number 1 of the impulsive move going down after the orders have been produced, what's really happening is the market is moving off of an order flow pattern. Basically, after each low is taken out, price action retraces to the last order block which was created before the move down to mitigate it and do the same thing except on the smaller time frame. So now there's orders over here that the market is going to produce, but the interesting thing now is that you no longer need to find you no longer need 2 million orders. All you need now is not a significant, but a small amount of orders to continue to maintain this downtrend. That's it. Now, some of you may be wondering, Okay, well, if everything's going down, doesn't that mean retailers are also going to get involved? Well, technically, the move down is actually to liquidate retailers, because before this move down happened, it was, followed up with a huge continuation towards the upside, a bullish market. And that invalidates, the downtrend invalidates all the liquidity, all those buyers that were buying this trend line and support and resistance and etc. So now we understand that from a deeper look of cycle number one, all it really is the market takes out a low, and then it retraces back into the last supply zone, takes out the next low, retraces back into the last supply zone, takes out another low, retraces back to the next supply zone, takes out the final low. But then what happens is, instead of retracing back to the supply zone, you get stopped out. And that's going to be another topic that we're going to cover in the latter part of this video. But for now, we're simply going to go over the deep look at cycle number one. Now, to provide a very good example on Euro USD from the weekly time frame, what can we see? We can see at this point that the market was rallying, extremely bullish. So imagine from December all the way to February. So that's about 3 months, if I'm correct, or 2 to 3 months, something like that. So yeah, well, it depends, December. Yeah, you can say 2 months and a half. That's 2 months and a half of bullishness, of a bullish market, a buy market. Now imagine how many retailers, how many new Forex traders are approaching the market every single day. I'll give you a quick story, matter of fact. One time when I was a brand new trader, as soon as it was Sunday, 5 p.m., I rushed to the charts and I went to the 1 minute time frame. And you know how sometimes trading view can be a little bit glitchy and the candles don't move and you're confused, like what's going on, what's going on? Well, that was me. I was like, why aren't the candles moving? I'm missing out on trades. I'm missing out on opportunities. And little did I know that was not what I meant. That's not what I should be doing, right? And that was all because of my impatience and ignorance. Because of course we're new. It's a new industry, and we don't know much, and we're excited. And so imagine that now times millions, because there's millions of traders, thousands of traders per day, thousands of millions of billions of dollars there to be liquidated. So what happens is, when you see the market going up like this, and a retail trader sees such a move, or someone who trades using the retail strategy, I should say, because we're all retail traders. But when someone who trades the iconic support and resistance trade with the trend philosophy, that when they see this, they're going to trade with the trend and they're going to start buying the market, right? Now, as smart money traders who try to mimic smart money, we know that after a specific time and after a specific, after the market reaches a specific point in price, we know not to buy. Even if the confirmation is valid, we do not buy. What do I mean by that? Well, it's called discounted and premium, and we're going to talk about that later on. But we know that instead of buying this entire move up, eventually selling has to come over. Selling has to take over, and this is exactly what happened. The market from this point here, we can see some type of distribution going on. Distribution simply means that the market was going up, and then we started to consolidate, we liquidated positions, and then we reversed to the downside. After that distribution took place, the market breaks structure right here, invalidating this bullish trend, liquidating all of those buyers. So everyone who is buying this move, trying to get rich quick, no, I'm just trolling, but anyone who was trying to buy this move and trade with the trend, they eventually got stopped out, unless of course they closed their positions and got out at a good nice profit. But those who didn't, they definitely got liquidated. And notice what happens afterwards. After that happens, the market retraces back to the original area where the first distribution took place. And then from there, the market sells off. Now pause. Let's take a brief pause. There were order blocks over here. We had an order block right here. We had order blocks. I think, to be honest, I think that's the only one that's coming to mind. Possibly one over here. Well, yeah, we had one order block here. Like I said before, why didn't this one? Why wasn't this order block maintained? Why did price invalidate it? Usually the market actually reacts off of an order block, gives it some type of reaction, but this one we literally just invalidated it, right? I think there must have been some type of order block over here actually. Yeah, it probably is one here. We're gonna have to double check that, but for the example, let's say there is. The market did not have, this order block did not have enough orders to provide the market with such a momentumous move down for weeks. Because now think about this. This move started on January 21st, and now is January. So it's basically 1 year of just sell side pressure. The market sold off for one straight year from 2021, from 2022 all the way to 2023. And if the market was not able to do it here, but it was able to do it here, then that tells us that it's about orders. It's about the numerical factor behind it. That some order blocks have more orders than others, and it's really simple. And I can just keep repeating it. Well, we're not going to get anywhere. So what happens next? So now we understand the first part of the cycle. This was the first part of the cycle, where the market reaches and finds the order block, the higher time frame level, the first supply, which is going to produce such a movement that's going to be continued for months to years, right? And this was that supply zone. I don't like purple. Let's change it to blue. So boom. From there, the market starts selling off. Now, what is the in-depth look at cycle number one? The in-depth. Now, we're going to focus on this red highlighted part, the movement down. And in this case, the movement down was followed for a couple of years. So, within this move down, there's definitely a few invalidations of demand and possibly some micro breaks of structure. Definitely some micro breaks of structure. And notice how the market retraces back up to the final area of supply, and then it starts going back down. And then from there, it's just a continuation of that same pattern. The market creates a new low or breaks past a new low, and then the market retraces back within the supply zone, which was the cause of that break. And then the market just continues and continues to follow that over and over and over again until we reach a point where sellers are no longer in control and buyers take over, meaning that the market maker's objective has changed. The mission statement is no longer to sell until, I don't know, like it's no longer to sell until however long you want to sell. It's essentially to change the market structure, not because everyone's selling. And this is the cycle basically. First, the market maker will sell when you least expect it. Oh, whoops. The market maker will sell when you least expect it, as in no one was expecting a huge sell at this point or this point. And then we go down, and now everyone's expecting the market to continue bearish. But as soon as you become confident in the trend reverses. And then what happens? A new cycle starts where the market goes back down. And then for the next few weeks to months to years, we start trading and following the new order flow pattern, which follows a demand zone. Sorry, not demand, but follows a demand. Now zooming in on the daily time frame, we can see that there's probably some type of supply zones in here, I can say. Just to check, let's go to the 12-hour. Yeah, there's definitely some type of supply over here that the market uses. Right, from there, we start selling off. And then after we take out this low, the market returns back to this 12-hour point of interest. As you can see, it mitigates it, falls, and then the market takes out the next low. And then we go down, we mitigate it, we fall, and then we take out this weekly level. This would probably be a weekly level if I'm correct. Let's go to the daily actually. Okay, there we go. So then the market mitigates this daily level of supply. From there it goes mitigates it, goes down, and it's just a continuation upon continuation upon continuation until the mission statement is changed. But the fact and the point of this video, the thing that I'm trying to show you all, is that there are many opportunities throughout the year to just sell. And within the year, there's also one mission statement that's going to be followed for a while, for a long period of time. As in from Euro USD all the way from last January to September, the market was literally just constantly falling. And that makes your life, if you understand the cycle, that makes your life a lot easier, because now you know what the trend is, i.e. the trend is up, you know the trend, but you also understand that the momentum is with the bears at the moment, right? Because supply is with the bears. As in, we could be in an overall uptrend, but the current momentum could be bearish because at the moment of time there's more orders than in the market. So it's not all about the trend, it's about where the orders are at the moment of time. And you can see on Euro USD, the orders were clearly with the bears, because we saw how the market would continuously mitigate supply after supply, supply after supply, supply after supply, until we reach a point where supply has gotten too famous. Not too much, but too famous, meaning that people tend to kind of get a whiff of what's going on. And then retailers also try to profit off of these strong prevalent move down. And then eventually what happens is retailers get involved, retail traders such as support and resistance traders. By the way, when I say retailers, I'm talking about these types of traders, the ones who trade support resistance, right? Our breaks and retests, stuff like this. Because as you can see, it just doesn't work as effectively as something like supply and demand would work, right? And that's the cycle. Matter of fact, we can even go into GBP USD. This for the last week, actually, sorry, for the last year, GBP USD was following a beautiful cycle number one, right? As we get, once again, it's literally textbook. Look at it. It's something like this. The market reaches a strong area of supply and is usually always at the top, and then for the next few weeks to months to years, the market just sells off. And you're wondering, why is it selling off? Well, it's because whilst you were looking to buy the market, everyone else was looking to sell at the tops, at the very tops. So on GBP USD, we can see the market reaches this area of supply. Now let's put ourselves in the shoes of a retailer, of someone who trades retail strategies such as support and resistance. Essentially, if you see this, you're not really thinking about what's to the left. You're more thinking about support. You're thinking about support here. So the difference between someone who trades supply and demand and someone who trades support and resistance is those who trade support and resistance aren't mainly looking at mid levels like here, as in this order block is in the middle of a huge area of consolidation. Rather, retailer traders who trade support and resistance are looking at areas like this, right? Areas such as this, more recently support, a resistance that's turned into support, resistance that's turned into support, resistance that's turned into support. They're more focusing on that type of stuff. And now that we go to the actually I don't want to go to the 4 hour. It's gonna get hectic. But boom. So look at what happens. Now as a retailer, you're expecting the market to go up, and just take a look at that. We start falling. The market literally melts. It literally melts. Now, what is the smart money trader doing? The smart money trader understands that structure is no longer with the bulls and structure is changing, and we can identify that through the breaks of structure, right? And that now I also know that there's a new supply zone that the market has to reach. So price is going to eventually make it there. Now, I'm not telling you to just wait weeks to months with no trade. No, of course, you could actually buy the market up to the sell zone and then sell. But that's a whole other topic for a different video. But what I'm saying is, if you know that the market has to reach this point, just the fact that you have information now that the market has to reach this point to create the cycle, you're one step ahead of the game. Because now I know that the market has to come here, and when it comes here, it's going to go down for a couple of months to years. And if I know that, then all I have to do is wait for structure to tell me what's my next move. Compared to everyone else who's doing a guessing game. They're literally guessing what's going to go on. They're like, okay, wait, there's a supply zone over here, and I heard that means that I should sell. So that means I'm going to sell it. Okay, hold on. Let me invest. Okay, I invested. Whoa, it's going down. Yo, it's working. It's working. No way. Boom. Stopped out. It just doesn't work, right? I'm just messing about, but it's not as effective. See, but then now we know that the market has to reach that point. So when it reaches that point, my next job is literally just to wait for structure to tell me what the next move is. So what does that mean? So price is in my area of supply. Now I wait. Okay, structure was broken. What do I do next? I find my area of supply. I find the area of supply which was the cause of this break of structure. I set my limit. Oh, it's going to take forever. But yeah, I set my limit. Looks like price doesn't make it there. But look at all the other opportunities that were present. Right, let's go to the daily time frame. We have this move down. We have a break of structure right here, as you can see. And then the market retraces back into this area of supply, and then it goes down. Similarly, again, we have a invalidation of demand, but not a break of structure. So of course you would not want to set a limit, but you'd also want to wait for confirmation instead. And then boom, the market retraces back into that area of supply to go down. And it's basically just order flow being followed until the objective changes. Right? We can see right here, this move down takes out the previous low. Let's label this as black. Takes out the previous low right here. This is the previous low. We take out that low, and then the market retraces back into the area of supply, which was the cause of that break, and then it goes down. Once again, we have this low. The market takes it out, and then the market retraces back into the area of supply, which was the cause of that break, and then the market continues its move down. And basically this continues to happen over and over countless times until, like I said before, the agenda changes, or until a certain point where these retracements just stop happening. And once you start seeing that these retracements, like as in price, let's say price breaks a low, retraces, breaks a low, retraces, breaks a low, retraces. Once you see that's not happening anymore, and rather price action is making very, very minor retractions and pullbacks, that's when you can assume that the trend is essentially dying down. It's coming to an end. And that's a whole nother cycle that we're going to talk about. Really, we're just focusing on the order flow part of the cycle. The next cycle we're going to talk about in the second part of this video, which is which hopefully should come out this weekend, inshallah, if all goes well. But yes, as I was saying, essentially when you see that the pullbacks are becoming smaller and smaller and smaller and less greater and less valuable, that means that the trend is essentially coming to an end, and that you've already missed out on those basic opportunities. And now if you were to actually catch those pullbacks, even if the market does pull back, there is a less probability. There's less probability behind the moves. There's less probability behind the trade, basically. Why? We'll take a look at this. Over here, everything that happened over here is considered to be premium. Everything that happened after here is considered to be discounted. Of course, I'm not measuring it, so I could be a little bit inaccurate. But the closer price gets into the discount level, the higher the chances the market is going to reverse. And the higher the market gets into the premium levels, the higher the chance the market has into selling off. And to provide a very good example of this, imagine we have a rectangle, right? Let's use red for sell, and then let's make this a bit more red. Let's use red for sell. Actually, I don't like red. Let's use purple for sell, and then we'll use blue for buy. Okay, cool. We use blue for buy there. The closer the market gets towards the blue zone, you could assume that the probability of selling has decreased by more than 50%. The closer it gets, and as soon as it's in the blue zone, selling is at 0. But then the higher the market gets near the purple zone, buying becomes 0. And then what happens? Selling becomes in control until the entire cycle is broken. And then what happens? A new zone is created. We have one over here, and we have one over here. A new cycle is created. Now price action is higher. We sell off, we sell off, we sell off. The market reaches the next blue zone. The market starts buying back up, goes back to the purple zone, and then we go down. And it's literally an entire cycle. And I just proved this using two pairs, GBP USD and Euro USD. Now, of course, you can't see it at the moment right now. Your job is to not predict, but to analyze what's going to happen next. You know, what is the market doing? Is it currently reacting off of areas of supply? Is the market not reacting off of area of supply? Why is it not reacting off of areas of supply? Are we moving off of demand now? Which zone are we in? Are we in the blue zone or are we in the purple zone? If we're near the purple zone, that means to sell. But if we're in the blue zone, that means to buy. So with that being said, understanding the cycle behind the market, and especially cycle number one, if you can understand the cycle of the market, then you'll have essentially a edge. You have some type of edge, because an edge is basically anything that taunts the odds, or not taunts, but points the odd in your favor. You know, it goes towards you a little bit more, and you have a benefit. You have something that others don't. And what that is, it's information before things happen. Once again, this is all conjecture, and we're just assuming. This doesn't always have to happen. But thank you all so much for watching this video. I hope this video was helpful and you found this video extremely informational. If so, leave a like, comment, and subscribe for more. I had no idea this has gone for 28 minutes, so we've gone way too long over. We've gone way over budget, but yeah, thank you so much for watching. I'll see you all next one. By the way, if you are interested in joining the course, you can make your way to teachable.com/TraqFX course to success. The link is in the description below. If you're interested in joining our course, sign up now, because we have a discount running for 50% off, and I'm not going to be doing a discount for a while soon, but yeah. And if you're wondering what's involved in the course, let's go to the Discord. As you guys can see, earlier today we did a live Zoom session for about an hour and 10 minutes. No, it was a full hour. Yeah, it was an hour and 10 minutes, I believe. No, hour and 20 minutes. We did an hour and 20 minutes live Zoom session where I sent signals, where I answered people's questions. We went over charts, we went over theories and strategies, and I even analyzed a couple of pairs. So if you're interested in joining the Discord and active community, feel free to join the course. With that being said, I'll see you all next week. Peace out.